Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Navigating Margin Calls, Strategies to Protect Your Investments. House margin calls. House margin calls add another layer to margin trading. These are specific to the rules set by your broker-dealer, and they can vary widely. It's their way of protecting themselves from risk while giving you some leeway to trade. How they work. Different brokers have their guidelines, known as house requirements. They can be stricter than exchange rules. Components. House margin calls are triggered when your account value drops below your broker's threshold. Think of it like the dress code at a fancy restaurant. If you're not up to standard, you're asked to change. If you face a house margin call, your broker might require a rapid response, more so than with maintenance calls. Staying in the know about your broker's specific conditions can prevent surprises and keep your trading on course. Both types of margin calls are essential for managing trading risks. Understanding these distinctions helps you maintain control and avoid unexpected disruptions in your trading activities. Consequences of margin calls. A margin call can feel like a sudden storm on a calm day, shaking the foundation of your trading strategies. When a margin call hits, it's crucial to understand its consequences, which ripple through both financial and emotional aspects of a trader's life. Let's explore these critical impacts. Forced liquidation. Forced liquidation is a direct response to a margin call. It occurs when a trader doesn't have enough funds to cover their maintenance margin. But what exactly happens during forced liquidation? Immediate selling. The broker will start selling the trader's assets without asking for permission. This act is like a fire sale, where assets are sold quickly, often at unfavorable prices. Reducing exposure. The primary aim here is to reduce the broker's risk, which is achieved by cutting down the trader's position to an acceptable level. Financial pressure. For traders, this process can lead to significant losses, potentially wiping out their accounts or setting them back considerably. In essence, forced liquidation is like the emergency brake in a car, sudden and jarring, but necessary to prevent further financial damage. It underscores the importance of maintaining your margin balance to avoid these automatic sell-offs. Emotional and financial impact. Margin calls can be more than just a financial strain, they also take a toll on emotional well-being. How does this play out? Stress and anxiety. Getting a margin call can feel like a punch in the gut, triggering stress and anxiety levels to soar. It's as if your safety net has vanished overnight. Decision paralysis. The pressure of immediate decision-making can lead to poor choices, including panic selling or over-leveraging in an attempt to recover losses. Financial strain. A hit from a margin call can stifle your cash flow, leading to a cascading effect of financial instability. The balance sheets might read like a disaster novel, with plummeting assets and vanished safety cushions. The emotional impact can be likened to riding a roller coaster, where fear and adrenaline tangle, leaving a trader exhausted and sometimes disheartened. The financial and emotional stakes are high, making it crucial to have strategies in place to manage margin calls effectively. These cascading effects highlight the need for vigilance and strategic safeguards when trading on margin. Managing one's emotions and finances wisely can mean the difference between a setback and a collapse. Preventing margin calls. Nobody wants to receive the dreaded margin call. It means you must either deposit more funds or sell your investments. To keep this from happening, you need to be proactive. Here are some effective strategies to protect your finances and steer clear of margin calls. Regular monitoring of accounts. Keep an eye on your investments. It's not enough to set them and forget them. Regularly checking your margin levels and account balances is like getting a routine checkup. It keeps your investments healthy. Check often. Set reminders to review your account weekly or even daily. Use alerts. Many trading platforms offer alert systems that notify you of low balances or significant market changes. Understand your limits. Know your borrowing limits and stay comfortably within them. By staying on top of your accounts, you avoid surprises and can act quickly if things start to go off track. Using stop-loss orders. Using stop-loss orders can be a safety net. They automatically sell a stock when it reaches a certain price, limiting potential losses. Here's how they can help you. Set it and relax. Once the order is in place, you don't need to watch the market constantly. Customizable limits. You decide the exit price, protecting your investments according to your comfort level. Risk management. Automatically minimize your losses, preventing a margin call from catching you off guard. Think of stop-loss orders as having a security guard for your portfolio, always ready to step in when things look risky. By implementing these strategies, you're not just reacting to market shifts. You're staying a step ahead and safeguarding your financial future. Real-world scenarios of margin calls. Margin calls aren't just theoretical concepts, they happen every day in trading. Understanding the real-world impact of margin calls can help traders avoid similar situations. Here are some notable cases and lessons learned from those experiences. Case study: a high-profile margin call. One well-known case involved the investment firm Long-Term Capital Management, LTCM, in the late 1990s. This hedge fund had a stellar reputation, boasting Nobel Prize winners among its partners and impressive returns. However, everything changed during the 1998 Russian debt crisis. The firm had taken massive leveraged positions, expecting stable economic conditions. When Russia defaulted on its debt, the markets fell sharply. LTCM faced a severe liquidity crisis and received a margin call from its lenders. The firm could not meet those demands, leading to its dramatic collapse. The aftermath sent shockwaves through global financial markets and required a $3.65 billion bailout to prevent a wider financial disaster. This situation highlights how quickly leverage can turn from a friend to a foe. One minute, you're riding high on potential gains, and the next, you're scrambling to cover losses. Lessons learned from margin call experiences. Learning from margin call scenarios can help traders avoid making the same mistakes. Here are some key takeaways. Know your limits. Always be aware of how much you're willing to invest and how much risk you can handle. Set strict limits on your leverage. Stay informed. Monitor market conditions closely. Economic events can have severe consequences, especially when using margin. Be prepared for volatility. Markets are unpredictable. Having a plan in place for sudden changes can save you from a margin call. Diversify your portfolio. Don't put all your eggs in one basket. A well-diversified portfolio can reduce the risk of significant losses. Understand margin calls. Know what triggers a margin call and how to respond. Being informed can help you act quickly and decisively. Traders who take these lessons to heart are better equipped to handle the complexities of the market. By understanding real-world margin call scenarios, you can navigate trading with more caution. Conclusion. Understanding margin calls is crucial for anyone involved in trading or investing. They are clear signals of risk and the need for careful management. Ignoring them can lead to significant losses and missed opportunities. Consider your current investment strategies. Are you prepared for the unexpected? Engaging with a financial advisor can provide clarity and help safeguard your portfolio against margin calls. Stay informed, keep learning, and don't hesitate to ask questions. This knowledge empowers you to make better investment decisions down the line. Your financial future depends on it. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.